Hi there, it's Michael Kramer of Mott Capital. Today is Tuesday, April 16th. It's around 6 o'clock New York time. So we're going to start seeing a very big slowdown in economic data over the next week. The biggest things on the list really are initial jobless claims coming on the 18th, which is this Thursday, 215,000. We're looking for leading indicators for March. That's expected to be a decline of 0.1%. Existing home sales, 4.2 million. And then really heading into the beginning of next week, we're looking at S&P Global Manufacturing PMI, Services, and Composite PMI. We still have some time for these, but I think the biggest numbers we're going to watch here are those prices paid numbers because they certainly have been giving us a good sense of where overall CPI is heading. The other thing that we're going to be paying attention to as we go through the rest of this week and the start of next is that this week on the 17th in that 1 o'clock time slot, we're going to have a 20-year Treasury auction. And then on the 18th, we're going to have a 5-year TIPS auction, which is the inflation protected kind. And then we're going to start heading back into 2-year yield auctions basically on the 23rd. And then on the 24th, we're going to get a 5-year auction. So Treasury auctions are going to start ramping back up again. The good news is Fed speakers will be kind of riding off into the sunset as of Friday, with Austin Goolsbee being the last one to chat. Today was Jay Powell's turn. He basically kind of walked back the expectation around rate cuts, how the progress around inflation has stalled. Also indicated that the Fed may have to wait a while longer to have the confidence it needs to begin cutting rates. And certainly when we look at where expectations are, market now sees the first rate cut coming in November. And at this point, we're not even sure if we're going to get two anymore this year. And to think at one point, markets were pricing in up to 7 rate cuts, which is, sort of crazy to look back on at this point. And so that really kind of, again, takes us back into the basics here, where it's becoming more and more clear that the ECB is looking like they're going to be cutting sooner rather than later. Christine Lagarde, although she didn't say that today, she sort of indicated it. Certainly the ECB speakers that have been coming out have been indicating towards a June cut, and that's being reflected in the weaker euro. And again, what I would think we're going to continue to see is the euro continue to weaken. Last week we had some questions as to whether or not this diamond pattern was going to persist. It looks like it has. And so the next level of support I'm thinking comes along is probably around that 105 area. But again, the longer the Fed has to hold rates higher, the more likely it is that the ECB is going to really be cutting, the more likely we're going to see the euro probably heading towards parity over some time. It certainly also sounds like the Bank of England could be looking to cut rates sooner rather than later. Again, I would think you're going to see the dollar continue to strengthen versus the pound, with the next major level here of support around 122. When we look at the yen, you can see that this has gotten up to this 154.5 level. Last week we were talking about, the potential for this thing to break out and move up to around 155. We've certainly have gotten there. There hasn't been any intervention yet. You can certainly make the case that the yen is weakening for fundamental reasons. We have certainly seen the spread between US 10 and Japanese 10-year yields widen out, and that's one of the reasons why you're continuing to see the yen strengthen. And so as long as rates in the US continue to move up, the BOJ kind of sits on its hands with its monetary policy. 10-year rates in Japan don't move higher. You're likely going to see, Japanese yen continue to move higher. Also, since we're looking at spreads, we might as well also look at the 10-year spread on the German and U.S. bonds. You can see U.S. 10-year minus German 10-year clearly has broken out. We've only risen to around 223 so far. You could make a case there's some resistance in this zone. It is a 50% extension of this move higher so far. But again, I would make an argument to say that we could potentially see this spread continue to widen and move up to around 2.5%, maybe even all the way back to 277, which was the highs that we saw back in November of 2018. Again, this is largely going to be dependent on economic strength and divergences between central bank monetary policy. When we look at the 10-year yield here in the U.S., there's certainly a case to be made that the 10-year yield could now even be heading back towards 493. You can see that momentum is obviously very bullish here, although it is starting to look like we're getting a little bit overbought on the 10-year. I would like to see a little bit of consolidation in this zone, but again, it's entirely possible. We've just been rising right along this upper Bollinger Band, and it seems entirely possible, given the economic data we've been getting, given the lack of economic data we will be getting, that the trend will remain intact, and we're going to see the 10-year yield rise to this 493 area if we were to break out above 467. The 30-year yield also looks like it's pretty close to continuing to move higher as well. You can see this 480 area has been serving as resistance. Again, the trends are very positive, with the potential for us to head back towards this 510 area. Certainly a very big possibility as we move forward. 2-year yields are basically hit that 5% mark again today. We're beginning to creep above the 5% level. Today we closed at we actually closed today at 499. So we're pretty much right there. And again, you can make a case to see the 2-year up at around this 5.05. Maybe it even makes it as high as 5.25%. I think that's really going to largely depend upon, how many more rate cuts the market continues to price out of the equation. And that may come very well down to what the Fed speakers have to say the rest of this week. Certainly when we look at the DAX, we were talking last week about it, and you can certainly see that the DAX has really started to give back now. The big level that I'm watching here in the DAX is the 17,625 region. Clearly, momentum has really broken down very materially, very quickly. We can also see that there's clearly been an uptrend that's been broken here. And we can also see that a downtrend has been established. So at this point, again, it looks like the onus is on the bulls if they want to try to get something going here and trying to lift the DAX. I would really be sort of watching for a breakout above this 18,055 area. However, I think that's going to be a fairly difficult thing. It really looks to me like we're seeing momentum really turn here. The reason why I'm saying that is because if you notice, the DAX got up to around 83 here. We got up to right around this 85-ish, 86 area here. But notice a difference in how the difference in price levels. And so really what you're beginning to see is a flattening out, potentially a divergence here forming. Also notice that this low is lower than this low, and that could be suggesting that we're starting to see a trend change in momentum overall. And with a break of below 17,625, potentially setting up a filling of the gap to this level at 17,153. The FTSE had been acting fairly strongly. We had gotten right back up to these old highs. That clearly came crashing down today, with the FTSE dropping by about 1.82%. I think in the short term, your support levels right around 7,740, while your resistance is still in this 7,950 to 8,050 area. When we swing over to the Nasdaq appears to have broken not only the diamond reversal pattern, it also appears to have broken a megaphone pattern. If these two patterns are correct, the downward movement we're going to continue to see in the Nasdaq should only grow stronger in the days and weeks to come. The first obvious area of support is 17,475. It's worth pointing out that the Nasdaq is now trading below the 10-day exponential moving average, the 20-day simple moving average, and the 50-day moving average. And in fact, the 10-day exponential moving average is now crossing below the 50-day simple moving average, which is a suggestion that momentum is again beginning to shift. So if this diamond pattern is correct, the next area of support I would look for is 17,465, with the levels after that coming around 17,010 and then 16,732. To the upside, if we were to breach this 18,250 region, it would invalidate this diamond pattern and potentially set up, I would think, the Nasdaq breaking above the 18,460 level. But I think for that to happen, you're going to really need to see the dollar begin to weaken, and you're going to need to see treasury rates begin to come down. And right now, I don't see a case for that happening. When we look at the S&P 500, that's also broken some major levels of support. It sliced right through the 50-day, the 10-day exponential moving average, obviously rolling lower. You can also see we've broken a downtrend here. Right now we're sitting right on support at 5,050. The next major level of support comes with a gap fill at 4,980. That's certainly a level we're looking for. I would be looking for a resistance somewhere around this 50-day moving average, call it 51 and a quarter to 51.50. The Dow had a better day than most, and that's mostly because the UNH reported better than expected results, rising by 5%. And so overall, what we have right now is the Dow breaking support at 38,625. You have the next level of support coming at 37,140 or so. Clearly, momentum is very bearish right now in the Dow. You can see that we've already hit about 30. We could probably still go a little bit lower here. Meanwhile, the Bollinger Bands, you can see we're just inside, trading right along it. So what this would tell me is, again, we could be looking at an area where we can see a little consolidation in this zone. You can certainly see that there's a case to be made that there is support right here, going back to these highs this low, carrying it across right at 38,000. So I would be watching that. With a break of this level, we're talking about 37,172, and then we're talking about much lower levels coming and fairly quickly, depending on all of this. Again, resistance probably the 10-day exponential around 38,390, and then probably in this area between 38,600 and the 50-day moving average at 38,900. Anyway, that's all we have for this week. Hope you have a good one, and I'll see you next. Bye.